All right, let's go. So looking into the next part of Peony Co, and let's finish the question today. And let's get started from where we left off yesterday. We looked into inventory exception, inventory count. Perpetual inventory count is that continuously counts happen, but if the counts are not complete, then there's a chance that your inventory may be overvalued or under or overstated. So that was the risk that we looked into last. Today we look into the next set of risk. Okay. Okay. Next set of risk. Looking into this here, the next set is, as we read the question, as part of interim audit, which was completed in May, an audit junior attended a perpetual inventory warehouse noted that there was a large number of exceptions where the inventory record showed a higher quantity than the physical quantity. तो यहाँ मिल गई गलती, right? They found a mistake. What did they found out mistake? First one was during the interim audit, जो साल के दौरान होता है, the audit that happened through the year. In the interim audit, they found that the warehouse records were actually greater than the stock records. Reality, mein, there's not that much inventory, but the books are showing that there is a lot of inventory. Okay, so this is what was found out. Okay, so this was the risk over here that during the interim audit, it was found out there were some exceptions were found. What is the risk? There were some exceptions were found. Okay, but why is this a risk? Why do we call this a risk? Because the year-end quantity will be based on these records. जो फाइनेंशियल स्टेटमेंट बनेगा वो ये रिकॉर्ड्स पे ही बनने वाला है. So there's a risk that the inventory may be overstated. There's a risk that your inventory might be overstated. So as a solution, what should we do? The level of adjustment made to the inventory should be considered to assess. It should be discussed. We should discuss this with the management and tell them as soon as possible. And it may not be possible to place reliance on the records at the end of the year, which could result in a full year inventory count. Right. First of all, though, we have learned that हम इस records we cannot rely on the record. That is the first thing. So first of all, we have to tell the management ASAP about the issue. ASAP, we have to tell the management. That we will tell the management is as soon as possible about the issue. Second, we will not rely on the inventory records at the year end, and we must attend the full year in inventory count. So जो inventory count होगा, we have to attend that inventory count, and we cannot rely on the records. We no longer can rely on the records. That first of all, we'll tell the management. First of all, we'll tell the management, and then second, we cannot rely on the records, so we'll have to attend the inventory count at the year end. Whatever the inventory count happens, we'll have to attend. We have to attend the full inventory count. Okay, must attend the full year end inventory count. Full year end inventory count because this was found during the interim audit. So at the year end, at the full year end count that will happen towards the end of the year, that we'll have to attend. That is the first thing. Moving on now. During the year, IA performed a review. The internal audit performed a review of non-current assets physically present in around one third of the stores. A number of assets had not fully depreciated were identified as obsolete by this review. So a lot of assets were there which were not fully identified. Number of assets which had not been fully depreciated were identified as being obsolete. So there are some of the assets they were not fully depreciated. So before the full depreciation only they have become obsolete. मतलब it's like बहुत ही young age में अब ये लोग at a very young before its useful life is ended, they have become obsolete. Right? Before the useful life is ended, they have become obsolete. Okay. This may be a hint that the company's depreciation policy is not correct. This may be a hint, right? It's an indication that the company's depreciation policy is not appropriate. As it seems that the inventory has seemed to be understated. The full depreciation has also not happened, and still the assets have become obsolete. Imagine that means the useful life was initially wrong. Right? So the depreciation may be understated and profit and assets may be overstated. You have to write off the assets also. What you have to write that asset off also. Now to it's obsolete. What will you do with it? Write it off. It is obsolete. What will you do with it? Just write it off. Next, discuss the depreciation policy of the non-current assets with the finance director. Discuss the depreciation policy with the finance director, first of all, and assess that whether it's reasonable or not. Okay. Second, any obsolete inventory ask them write it off. And if they have written it off, review the adjustment. First, you tell them to write it off because now the asset is obsolete. There's no use of the asset, so they have to write it off. And if they have written it off, you check whether they have done it correctly or not. And if they have written it off, you check whether they have done correctly or not. Okay. Next, the company launched a TV campaign in order to increase revenue. Director indicated that at the year end, a current asset of 0.7 will be recognized, as they believe that the advertisement will help to boost future sales in the next 12 months. The last advertisement was shown in early 2005. So Peony Co is planning to include a current asset of 0.7 million. Right? Peony Co is planning to include an asset of 0.7 million, which relates to advertising cost. Right? They are planning to take an asset, advertising cost, they are planning to record it as an asset. Okay. The cost were included and adverts were shown in ending in the year in 2005, and there is no basis for including them as current assets. So why are they including them in current assets? There is no basis of including them only. There is no basis of including them. Right? First of all, you discuss with the management that why are they doing this? Okay. And review supporting documentation to confirm that they were all shown before 2025. Right? So there's a risk over here that operating expenses in the financial statements, ये जो advertisement expenses है, whatever the advertisement expenses are there, they should be recognized in operating expenses. Right? Why are you recording a current asset? Right? Why are you recording a current asset out of them? There is no reason to record a current asset out of them. So the cost, your current assets will be overstated. Why are you recording it as a current asset? Advertisement expense, just expense it in P&L. They are telling because of ad, future profit will come, future cash flow will come. So today we will record it as a current asset. But advertisement expense should always be expensed in P&L. It should not be recorded as an asset. So they are doing a wrong treatment here. So first of all, you discuss with management why are they doing that, and they are telling future inflow will come. So you ask for supporting documentation. On what basis are you telling? And just make sure everything is there before 2025. Whenever a date is mentioned or a part of the year is mentioned, there is a good scope to do testing. That review the supporting documentation to confirm that they all were shown before 2025. To ensure that they all were shown before 2025. Okay, and also request the management to remove it from current asset and record it as an expense in P&L. This is what you have to request the management. Remove it from current assets. There's no reason to record an advertisement expense in current assets. Tell the management to remove it from current assets and record it in P&L. Right? Record it in P&L. Remove it from current assets and record it from P&L. Right? Remove it from current assets and record it in P&L. Right? Remove it from current assets and then record it in P&L. You have to tell the management to record it from current, remove it from current assets and record it in P&L. Okay, remove it from current assets and record it in P&L. Remove it from current assets and record it in P&L. Okay. Remove it from current assets. Record it in P&L and remove it from current assets. Remove it from current assets and record it in P&L. Remove it from current assets and record it in P&L. Moving on now. Peony decided to outsource its payroll function. So whenever you outsource something, right, detection risk goes up. So during the year, they are outsourcing the payroll function. And if you outsource, the detection risk goes up because see, we can't audit them. Right? If you outsource something, your company auditors cannot audit them because that company is not our client. So we cannot audit them. So there's a huge detection risk. Okay. The detection as to whether sufficient and appropriate evidence is available at Peony to confirm the completeness. Right? A detection risk arises. Right? A detection risk will go up because we cannot freely audit the client, their service provider. We can audit the client. We can't audit their service providers because the service providers are not our client. We can only audit the client. Right? So first of all, discuss with the management the extent of the records that are there at Peonico. Second, consider contacting the auditor of that particular organization and ask for a type 1 or a type 2 report. Right? See, Peony, this particular company has outsourced something. You cannot audit the outsourced company, but you can contact the outsourced company's auditor and tell the auditor to give you either a type 1 report or a type 2 report. And you can tell the auditor to either give you a type 1 report or you can tell the auditor to give you a type 2 report. Okay, you can tell the auditor to give either a type 1 report or give you a type 2 report. You can tell the auditor to do either give you a type 1 report or a type 2 report. You can tell the auditor to either give you a type 1 report or to give you either type 2 report. Okay. Pianico maintained its own payroll records. At the whole, they were transferred to the service organization. Okay, on 1st May, you have transferred everything to the service organization. Okay, before you maintained your records, then you transferred everything to 1st May to the service organization. Okay, which was 5 months before the year end. So there was a risk that during the transfer, a lot of errors would have taken place, right? And wages and salaries might be overstated. There's a risk that during the transfer, errors would have taken place. During the transfer, errors would have taken place. Okay, so what you have to do is discuss with the management the transfer process undertaken and any controls which are put in place to ensure completeness and accuracy. In addition, perform substantive testing of the transfer of information from the old to the new system. The payroll function was transferred to the service organization from 1st May, which is 5 months before the year end. 5 months before the year end, everything was transferred. Now there was a risk that during the transfer process, some mistakes would have happened. And the wages and salaries might be over or understated. So what you have to do is discuss with the management how the process of transfer would have taken place and ensure it was complete and accurate. Also perform some substantive testing on the transfer of the information from the old system to the new system. Okay. Also test that transfer of information from the old to the new system. Test the transfer of information. Okay. What you should do is test the transfer of information. What you should do is test the transfer. Okay. What you should do is test the transfer. Okay, what you should do is test the transfer. Test the transfer of information. Very important. Test the transfer. Next, bank loan. A 3 million loan was obtained in June 2005. Okay, a 3 million bank loan was obtained in June 2005. Okay, a 3 million bank loan was obtained in June 2005. Now, what is the problem with this? There'll be an incorrect classification of current liability and non-current liability. See, whenever you get a loan, whatever you have to return in just the coming year, that is your current liability. Whatever you can return after that is non-current liability. Okay, that is a non-current liability. So there's a failure to classify properly, right? So what you have to do is you should reperform the company's calculation to confirm that they have recorded current and non-current liability properly. Okay. In addition, the disclosure of this loan should be reviewed to ensure that it's in compliance. Two risks are there. One, they have not done the split. Second, they have not made adequate disclosure of the loan. Right? One, they have not done the split. Second, they have not made adequate disclosure of the loan. They have not made an adequate disclosure of the loan. Two risks. One, they have not made an adequate disclosure of the loan. One is they would have not made an adequate disclosure of the loan. Okay. They would have not made an adequate disclosure of the loan. And they would have not done the split correctly. They have not made an adequate disclosure of the loan and they would have not made a split correctly. Not made an adequate disclosure of the loan, not made the split correctly. That would be the two risks. So what you should do, reperform the calculations to confirm that the split was done correctly. Reperform the calculation to inform that the split was done correctly. Also review the disclosure. Review the disclosure to ensure that it was in compliance with the accounting standards. Do the disclosure to ensure that it was in compliance with the accounting standard. Okay. To make the disclosure to ensure that it was in accordance with the accounting standards. Next, redundancy provision. So they are planning to make approximately 60 employees redundant. No decision has been made yet or it's not been announced. Okay. So they would have not, see, whenever you remove staff, you should make a provision. They would have not made the redundancy provision. So your provisions and expenses would be understatement. Right. So whenever you plan to make a redundancy provision, you should make a allowance for that. A redundancy provision is required at the end of the year. So there's a risk that that would have not been created. So discuss with the management the status of the redundancy announcement. Discuss with the management the status of the announcement. Discuss with the management the status of the redundancy announcement. Okay, discuss with the management the status of the announcement. What you should do is discuss with the management the status of the announcement. Discuss with the management the status of the announcement. Right. In addition, ensure that the provision that is calculated is accurate or not. Right? Is it adequate? Recalculate the redundancy provision and review the basis. Right? Recalculate the redundancy provision and review the basis. Recalculate the redundancy provision and review the basis. Okay, recalculate the redundancy provision and review the basis. Okay, recalculate the redundancy provision and also review the basis of it. Recalculate the redundancy provision and review the basis of it. Okay, recalculate the redundancy provision and review the basis. That on the right basis have they calculate redundancy. Basically, when you remove the employees, you have to make a provision because you'll have to pay them, right? If you're removing them simply, you'll have to pay them some amount of money. So you need a provision for paying the employees. You need a provision for paying the employees. So that is called as a redundancy provision. You need a provision because you have to pay the employees, and that is called as a redundancy provision. Okay, that is called as a redundancy provision. Because you have to pay the employees, so you need a provision. That is a redundancy provision. You need that provision. So discuss with the management first of all when the announcement has been made. If it's before the year end, then review supporting documentation to confirm the timing. Is it before? Is it after? Okay. So first of all, you do that. Second, in addition to review the basis and recalculate the redundancy provision, just to review the basis if it's correct or not. Is the basis correct or not? Okay. Is the basis correct or not? That is about the provision, and that is about Peony.